breaking news on Canada's economy, which appeared to stall in the second quarter. Canada's GDP fell by 0.2% in the month of June. Investment in housing and new construction both dropped, contributing to the increase. Today's GDP report is the last major piece of data before the Bank of Canada makes its next policy decision next week. And joining me now is Pedro Atunes, Conference Board of Canada's chief economists. Pedro, thank you for being here with us.
It's a pleasure, Renee. Thanks for having me.
So, what is your reaction to this?
Well, it may seem a little counterintuitive, but I think this is good news. Perhaps we're finally starting to see that the shaping of a soft landing here with essentially second quarter growth really flattening out. As you mentioned, June is down, and they've given us a preliminary look at July, which seems flat. So we'll hopefully end up with essentially what the Bank of Canada was aiming for, which is to slow consumer spending and be on that path to lower inflation. And really important in the second quarter, it was the consumer that eased up a lot from that surge in spending that was very resilient in the first quarter. So I think that's a bit of a relief. And, hopefully we'll see, again, inflation heading in the right direction with these numbers.
Now, investment and new construction dropped. What are your thoughts on that?
Well, again, this is what was expected. Where we really saw a decline in investment was on the residential side. So we know that new home construction has been coming down. We know that the real estate market in general for existing homes has been dropping because of that impact of higher interest rates. So again, the policy decision to raise rates here is working in that market. Where there is another sign of good news, though, is that when we look at investment in machinery and equipment in structures, that what we call productive capital, that's finally turned around after quarter of declines. So I think there's some good signs here. The other piece that's easing is the inventory build. And, Canada's had a huge inventory build over the last number of quarters. And that means that essentially a lot of wholesalers and retailers are holding a lot of stuff that they want to get rid of. And that's especially on the durable side. Think back to, furnitures and mountain bikes and all those things that we wanted during the pandemic. Now we're not buying anymore. And so we're going to see, I think, some prices, at least for some of those components, continuing to ease.
We're expecting an interest rate announcement from the Bank of Canada next week. What could this mean for that?
Well, I'm hopeful that we'll see essentially the bank hold off on any further interest rate hikes. If we go back to kind of the impact of monetary policy on the economy, we know it takes fully 18 months to feel the full impact. So what we're feeling, essentially is the full impact of those very first interest rate hikes that we had back in March of 2022. We've got a whole slew of interest rate hikes over the last 18 months that still haven't had their full impact on the economy. So I think there's still a lot of, let's call it the foot on the brake from the part of the central bank, even holding rates as they are. And I think we've got good signs here from the data, from the inflation numbers, from the labor market numbers, that the policy is working.
All right, we'll have to leave it there. Pedro Atunes, Conference Board of Canada's chief economist, thanks so much for joining me today.